Welcome to this explainer where we're going to take 68 minutes of complex chart reading and distill it into a raw, step-by-step masterclass on market structure. I'll be your mentor today, and you are going to learn exactly how the pros spot high-probability entries using structure, liquidity, and confirmation techniques.
Why does this matter so much? Because let's face it, if you're fighting the overall trend, you're literally just handing your money to the market. By the end of this, you'll know how to stop catching those falling knives, how to dodge the deliberate traps designed to wipe out retail traders, and how to start trading with rock-solid confirmation-based logic.
We've got a strict playbook to get through today. We're covering the core market phases, structural highs, lows, and breaks, how to avoid institutional traps, trading supply and demand, multi-timeframe mastery, and finally, a professional execution checklist. All right, let's kick things off with Section 1. Core market phases.
Now, context is absolutely everything. Before you even think about looking for a trade, we need to ditch those arbitrary trend lines. You know, those slanted, imaginary lines retail traders love to draw that always seem to break and fake everyone out? Yeah, forget those. We're going to focus on reading raw price structure. That means tracking the actual, real highs and lows of the price action. And reading that raw data is actually pretty simple. An uptrend, prices are just getting higher. A downtrend, prices are getting lower. In consolidation, well, that's just sideways noise with no clear direction. So here's our golden rule. We buy in uptrends, sell in downtrends, and sit completely on our hands during consolidations. If the market is undecided, we stay out. Simple as that.
Moving right along to Section 2, highs, lows, and breaks.
Let's break down the actual mechanics of an uptrend. Sure, higher highs are great. They push us into profit. But it's actually the higher lows that are the real MVPs here. They protect the entire integrity of the trend. Think of a higher low as your structural floor. If the price caves in and drops below that floor, boom, your trend is officially broken. Now, inside these trends, you're going to see two very distinct types of moves. First, you've got impulse moves. These are the massive, aggressive pushes creating those new highs. Then, you have corrective moves, these slower, exhausting pullbacks. Here's where your edge comes in. You want to buy deep inside those bearish corrective pullbacks. You're essentially getting a discount right before that next massive wave of institutional buying kicks off.
But how do we actually know when that impulse is confirmed? We look for a break of structure, or a BOS. This happens when the price literally breaks past a previous structural high or low. What you do is draw a strict horizontal line right at those peaks. This removes all the guesswork and keeps your analysis totally objective and fluff-free. Okay, Section 3, avoiding institutional traps. This is a big one. Let's talk about the mistakes that get retail traders absolutely crushed. Ever wonder why you get stopped out selling after a minor pullback? The first major trap is getting totally faked out by internal structure. Listen, anything that happens between a major swing high and a swing low is basically just corrective noise until a true break of structure happens. Amateurs see a tiny drop, they panic sell, and then get obliterated when the main trend resumes. Trap number 2, misreading candlesticks. Never, and I mean never, treat a simple candle wick as a valid break of structure. Wicks are liars. They're actually showing you an institutional liquidity sweep. A true, safe break of structure requires a large, solid candle body to cleanly close right past your level.
Let's look at the psychology behind this, because it's fascinating. Institutions have massive orders to fill, right? And they need your liquidity to do it. So they deliberately push the price past obvious highs just to trigger retail stop losses. They are literally manipulating fear and greed. That wick that gets left behind, that represents smart money immediately rejecting the price after scooping up your liquidity. Always wait for those full candle body closures to confirm you're safe.
Which brings us to Section 4, trading supply and demand.
So how do we actually put this together and trade it? We look for demand zones characterized by an imbalance. An imbalance is basically an open candle range where no wicks overlap. It means buyers stepped in so incredibly fast that sellers literally didn't have time to react. That leaves a void in the price, and that void acts like a giant magnet for future price action. We're looking to place our orders at the last sideways candle right before that explosive, imbalanced move.
Now you might be wondering, what happens when I lose a trade? Because you definitely will. But here's the beauty of it. Mathematically, following market structure and strict risk management is your ultimate safety net. If you take a loss on trade 1, you only lose your 1% risk. No big deal. Because on trade 2, if you catch a pro-trend move from a demand zone, you could net a 3.94% reward. meaning you could literally lose half your trades and still walk away highly profitable. Protecting your capital is the absolute name of the game here. Sticking to a strict risk-to-reward ratio completely removes the crazy psychological pressure of feeling like you need to be right every single time. Trust me on this. You do not have to be a perfect trader. You just need your math to outpace your mistakes.
Moving on to Section 5, multi-timeframe mastery.
If you want to stop guessing and start trading with real, undeniable confidence, you've got to use a top-down approach. Step 1, identify the massive swing structure on a higher time frame, like the 4-hour chart. Step 2, drop down to the 30-minute time frame so you can monitor those slower internal pullbacks. And step 3, patiently wait for that 30-minute trend to break structure and snap right back into alignment with your 4-hour bias.
And that gives us our unbreakable confirmation rules. First, never place blind orders just because you're feeling FOMO. Don't do it. Second, let the price calmly enter your higher timeframe demand zone. Third, sit on your hands and wait for a lower timeframe break of structure. That proves smart money has stepped in. And finally, only then do you buy the pullback of that newly confirmed microtrend.
All right, let's bring it all home with Section 6, Execution Checklist. Here's your actionable professional playbook. Seriously, you might want to screenshot this and run through this exact sequence before every single trade. 1. Is your major swing trend identified? 2. Do you have a valid break of structure, confirmed by actual candle closers, not wicks? 3. Have you marked an imbalanced zone? 4. Do you have your lower time frame confirmation? And 5. Is your stop loss placed safely outside that zone? Following this eliminates retail emotion completely.
There's a great quote that says the goal with trend trading is not to be right all of the time. The goal is just to have positive risk reward and positive expectancy. As a trader, you really just have to embrace that losses are a cost of doing business. But if you religiously stick to market structure, demand confirmation, and manage your risk like a pro, your math is always going to secure your long-term success. So here's the question I want to leave you with. The next time you look at a chart, are you going to trust some arbitrary, imaginary trend line, or you're going to read the raw structure of the market? The charts are always telling a story about massive institutional money and the traps they set for the impatient. The tools to navigate it are right here in front of you. Are you ready to finally listen to what the raw structure is actually saying?